So if you're looking for investment, cash is not very good. Shares are volatile outside of high yielders. And then people start looking, first of all, at residential property, houses and units. We look at this yield here across for both. Traditionally, and that's still the case, apartments will always pay. You can see your houses and units both playing in the 4%, mid 4% there across in recent years. But one thing that doesn't change is the yield. You have 4.5% on a house, and it doesn't seem to change much over time. As you get closer to the city and you get more expensive houses, if you get right into the middle of town, the yields actually start to drop because the house prices are so expensive. As you move out and you move out to areas like this, the yields get better. So actually, if you're in the business of looking for a return on your money, residential property is better as you move out from the city and out to the city fringe, and beyond the city fringe particularly is where you get the best yields. That's been the case for some time. So keep this in mind when I'm talking about how the whole focus in investment markets and business at the moment is about yield. Because this is A&P, so this is internal from one of the biggest financial institutions in the country. And they're saying the commercial property risk premium is about as high as it ever gets. And what they're saying is that the returns in property beyond residential are about as good as they ever get. And if I, in my mind, associate an area like Sunshine, I think of its property dimension. So, checking the time, I went and I did some work and just had a look as much as I could about how does this hunt for yield play into your region, into the area of Sunshine. Well, this is Melbourne Industrial, first of all. And this is not this is the prices themselves, right? Now, you can't expect the prices to fly up at 3.5% GDP growth, but you would hope that they are solidly, consistently growing. And that's exactly what's happening. If you look north and west, that's the blue line. So we're seeing good, reasonable price appreciation in prices, but we're seeing very, very good yields. So and you get a trade-off there. I think those prices will actually start to accelerate. And what will happen is that the yields in this area will compress. By that I mean they'll get smaller, because that's exactly the process that's already happened in the banks. 2 or 3 years ago, the banks were doing 7, 8, 9% just after the GFC. People rushed in to get that yield. They rushed in so much, this basic economics, the price went up, the yield went down. I think you'll see something very similar happen in these areas, in industrial. And one of the things I know, because we follow at Eureka Report, what we follow is private investors and a lot of sophisticated investors. Where are they putting their money? Where are they going? And what's the demand? And we're being asked to cover industrial property more and more, which we never were before. And that was always seen as an area that the funds dominated. But you see now the DIY fund explosion. This is what they're looking for. There's 1 million people in Australia now with DIY funds. And most of them are retired or close to retirement, and most of them don't want to get 3% from the bank. Not all of them are comfortable with the share market. Some people are never comfortable with the share market, and I don't blame them. And then they move into industrial property, and they say it's something that's tangible, and they start to see figures like this. This is now bringing it right down into your area, into your part of the city. And we'll take a look again and say, okay, the city average, which is pretty good, you got to say, by any standards. If you look at the western area, we're looking at prime rates, prime yields of about 7 3/4, and you're looking at secondary yields of 9%. 7 3/4 for prime per annum on every $1,000 you put into that sort of property around here. Think about that, 9% on every $1,000 you put around here in property. And if I go back to the yield, think about that, 7 and 9%. And now let's go back and look at the yields across the board. Can you see anything between 7 and 9% there? There isn't anything. Nothing comes close. There's cash, it's 3 and a bit. Housing, perhaps 4, if nothing ever breaks. If the toilets never block, if the windows never smash, if the tenants never call you. Bonds, 10-year bonds, pretty steady there, starting to be something like average or normal. Corporate bonds coming up 4.5, but there's a tiny market in Australia. It almost doesn't exist. There's only a handful of them. Property trusts starting to get up there, 4 and 5%. Shares, the best of them, the banks, the big four banks. Big four banks, 25% of the market, coming in, bringing in very high yields, pushing up that number. But what really pushes up the number is non-residential property. And what pushes the number even higher is if you go to the districts, such as Melbourne Industrial, which is this particular zone. And the point I'm trying to make is that in many ways, from my point of view, certainly, on that dimension of the land underneath you, the property value of the area, you're in a sweet spot. Because this hunt for yields, which completely characterizes the market at the moment, is all about the particular returns, and the particular returns you can get above cash are in this particular strata. And I think these figures actually show you that. They certainly proved it to me. I'm going to write a column about it when I get a chance. But it's part of changing the perception. So you have those two things coming together. You have the changing nature of the fabric, if you like, of this the industrial activity out here, which is perfectly healthy. It's associated with manufacturing. That is an issue, but it's only a perception issue. And then you have the particular, very, very useful issue that you're in a sweet spot when it comes to not just property, but in terms of the entire economy is focused on one thing at the moment: yield. Give me better than 2.5%. And in this area, you're off the chart when it comes to the yields. And that is a very nice base, I think, to start from.